Howdy, Jacob here. Today we're going to do a more in-depth analysis on LexinFintech Holdings, company 90 of our dividend yield screener. It looks like with the initial assumptions, we were getting a price within 4% of where it's at now. And if it gets within 10, I try to do a deeper dive on the company. This isn't to supplement any sort of information you can get on your behalf. Every investment's going to be every investment that you do should be on you. This is just to supplement that by giving slightly more information and to just kind of go through my thoughts of the company. And so we'll first go a quick reminder through the financials. We have a $335 million market cap with $153 million enterprise value. It's a consumer finance industry. It's a fintech company out of China, and it's very new. It was founded in 2013. And from initial pricing, we see that it looks extraordinarily cheap with a 1.8 PE and a zero point 0.3 price to book. And then it has a current yield of 11.4%. So let's start to get into some of the things that I wanted to talk about today. So some of the notes I wrote after reading some of their quarterly reports and their 20Fs is that, again, this is a new business. It originated in 2013. So there's not a lot of history. I prefer companies with a lot of history that I can back up my reasons for. And a newer company like this is not going to have all the data that I want for me to be able to forecast, X years in the future when it's barely been around for 10 years. It's a tech personal financial service enabler in China. So very similar to Finvolution that we looked at earlier as well, where the company's assumptions look a little odd due to the fact that it's a Chinese company and it's in the financial services industry within China. Their CEO emphasis is on loan origination target. They balance growth with risks and cautiously navigating uncertainties. I pulled this directly from one of the quarterly reports to just kind of see where the CEO's mind is at and what they focus on. I really like the CEO, CFO to really focus on free cash flow over anything, but something like loan origination target is going to get them to their desired revenues and hopefully get them to, when they say balance growth with risks, hopefully it's a very vague statement, but hopefully they're truly doing it, and you can see through their actual quarterly reports whether they come through with that or not. It is a advisory share, so it's held in the Cayman Islands. I do want to show this. They have an increase in current assets and a decrease in total liabilities. And I know I don't usually value anything off of the balance sheet, but I know I also post a video on net, and so I just wanted to portray this so you can see that of the December 2022 to September 30th, 2023. This is in their most recent quarterly report. We can see that their total current assets actually increased, and that was an increase of almost a billion RMB. And then, where's that? Yeah, and then their total liabilities actually went down. And so, from a net perspective, total current assets went up, total liabilities went down, which is positive for them. And over here, I just did a quick summary of net to go over it maybe within 30 seconds. A net company is where you look at the current assets and you take away the total liabilities and the total market cap. And if it's positive, then you have a net company. And then I did a farther in-depth analysis where you are really looking for liquidation value. And so on a conservative perspective, cash equivalent, short-term investments, those type of things are going to be 1-to-1 because it's the current price on the balance sheet is the current value of that. And so I just take that 1-for-1. Receivables might be given at 75%. And so I'm taking the total receivables and taking 75% of it. And then on inventories, we're saying that if you're liquidating it, it's at 50 cents on the dollar. And then again, total liability is all the same, market cap the same. And you can see when you just take the full current assets minus total liabilities and market cap, you get a $280 million difference, because again, this is in billions. But if you take the more Ben Graham conservative approach where you're just looking at liquidation value and you say receivables and inventories aren't necessarily one for one, but maybe 75%, 75 cents on the dollar or 50 cents on the dollar, you actually don't quite get to that net net statement. But net net with positive free cash flow, it doesn't necessarily mean buy, sell. It just means it's just a safe haven to where you have assets to back up what the actual business is that you're buying. And so this company does produce cash flow. And so this is just a safe measure to say that their total current assets are greater than their total liabilities. And then the next note I have here is that their CEO is a founder and director with 26% of the shares and 77% of voting power. So we clearly have an individual who's vested into this business. They're going to want to do things that are hopefully in their best interest, and their best interest is hopefully our best interest, as they own 26% of shares outstanding and have all the voting power. And so we're hoping that due to them having as much stake into the business, or way more stake in the business than most of us have dollars for, as 26% of the business is over $100 million. They're going to likely make decisions that are best for the business and not for any other reason. We really like to see insider ownership, and we have that here, which is great, which basically means that uh, the board and CEO who has most power is going to make decisions that are best for you as the investor, as the owner of the stock. And so I wanted to point out something interesting about the dividends. And so their most recent 20F, which was filed at the beginning of this year, says LexinFintech Holdings has not declared or paid any cash dividends, nor does it have any present plan to pay any cash dividends on any ordinary shares in the foreseeable future. And then, strangely enough, about halfway through the year, we see that there is a dividend payout, and not only is it a dividend payout, it's a very large dividend payout in comparison to their market cap. It's 11.4% dividend yield, very large. But what they said about it is that this is going to be a semi-annual dividend set at between 15 and 30% of the company's net profits for the prior 6-month period, and it is obviously subject to adjustment and termination by the board. And so we see that the board made a decision where initially they were saying we don't see any cash dividends in the future, and then I don't know, what changed this mind, but they ended up saying that, hey, we're going to send out about 15 to 30% of our net profits into this dividend. And then one note that I have, which is an unattractive, a negative to me, is that they don't show cash flow statement in their quarterly reports, just the 20F. And so when I looked at their cash flow statement, I had to look at older data, which again can be fine, but I really like to look at cash flow statements quarter over quarter, and they don't show that here. And so I think to get into my new assumptions here, they're all very similar. I just increased the variability of margin. I have 1% buyback of shares since they're buying back a lot recently with their excess free cash flow. And then I lowered their terminal P and price to free cash flow based on their historical P and price to free cash flow. So this is using their historical PE ratio and saying that it's been as low as 2, as crazy high as 25, which isn't crazy for some companies, but pretty variable for this company. So I went somewhat conservative and said 2.5. And then again, it's a small company in China, held in China, which means I want a bigger return on the business. And so when I put in my new assumptions, I'm also going to decrease this by 2, the current dividend yield. And that's because, again, they said initially they want 15 to 30% of net profits. And I'm saying that their net profits may not be as high in the future as it has been as high as 20%. I'm saying maybe 12%, which would decrease their dividend payout, which would have the company stock price have to go down 42% before you get 17.5% discount rate. I think for me, I think it's a good company, but I think it's at a great valuation, but it's just whether you feel comfortable owning a company in China, because companies in China, especially ones that aren't as well known as Tencent or Alibaba, may not numbers might not be truthful, and you want to hope that they are, but you don't have any SEC to back you up and to confirm that these numbers are actually like 100% reliable. And so this is just going to be on you to do further research to see if you're comfortable. But again, for me, I'm just waiting.